We've been observing the Australian residential market for 2 decades now, and what we've learned over time, and what we learn about most asset classes, it's really the credit cycle that drives returns. It's not necessarily demand and supply of the asset itself, it's the willingness of borrowers to borrow and the willingness of lenders to lend. And it's a confluence of those two factors that sees credit grow and asset values go up. What we've seen in Australia from 1991 is credit growth growing double wages growth and more than GDP for 25 years compound. So what that's caused is our bank's loan book to move from 20% housing to 60% housing. So our banking system is entirely based off the Australian residential market now. The credit growth we've seen over that period of time has caused, as you'd expect, massive house price inflation to a point where it's a large percentage of household income, and where household debt to GDP is up near 130, 140%, which, I will add, is much greater than where the US was prior to the global financial crisis. So it's credit growth that's really going to determine whether or not the housing market turns and corrects. Now, an important aspect to note about the housing market, a crash. They don't crash like a stock market crashes in a few days. It's very, very slow. On average, we've seen Reinhardt and Rogoff in their famous book about crashes of housing markets that it takes on average 6 years. So the market can decline 3 to 4% per annum for 6 years, and you're halfway through it before you know what's going on. You look at the case of Japan, their housing market's gone down 1 to 1.5% per annum for 20 years. It's very, very slow. It's not a crash as you'd see with the stock market. So that's an important point to make. But the critical component or critical data point to look at is credit growth. Credit growth is freely available from the APRA website and from the Reserve Bank of Australia, and it is still growing, but it's falling. It's not growing like it once was. It's growing at 1 or 2% per annum now. If that moves into negative territory, that's your signal that housing asset values are likely to decline.